Good afternoon, ladies and gentlemen. My name is David Tam. I'm the chair of the Funds Commission. Welcome to this February 29th, 2024 meeting of the City of San Diego Funds Commission. We're going to do a quick roll call to confirm commissioner attendance. When I say your name, please say present. Commissioner John Peel.
Present.
City Attorney Mara Elliott.
Present.
And myself, Commissioner David Tam. Thank you. Attendance has been noted. For the record, we have a quorum consisting of Commissioner John Peel, City Attorney Mara Elliott, and myself, Funds Commission Chair David Tam. Also present are Marguerite Middaugh, Deputy City Attorney Allison Bonney from Northern Trust.
Present, yes.
Perfect. Silva Thomas from Northern Trust, Jeff Knipp from Siegel Marco Advisors, and Jeremy Shortis, Office of Boards and Commissions Liaison. So let's begin with the approval of the minutes for November 30th Funds Commission meeting 2023. Are there any changes to the minutes that were provided? Hearing none. Is there a motion to approve the November 30th, 2023 meeting minutes?
Motion to approve the minutes.
We have a motion by John Peel and a second by myself, David Tam. To approve. We'll now take roll call to count the vote. Commissioner John Peel.
Aye.
City Attorney Mara Elliott.
Aye.
Myself, Funds Commission Chair David Tam, votes aye. That motion passes unanimously. Let's move on to the agenda, starting with informational items. We'll take up item number 1, the report from Northern Trust regarding Mount Hope Cemetery Fund investment and performance review. Allison Bonney. I will hand it over to Allison Bonney from Northern Trust to present this item.
Thank you, everyone. So let's move on to page 2 of the deck. There we go. The next page is the agenda. So I'm going to spend most of my time giving you sort of the executive brief, talking through the numbers. We do have detailed information in the deck. I will pick on a few slides just to give you a sense of the market and probably verbally update you, since this deck was prepared a while ago and we're just finished the month of February. So I'll give some information on that and then any details that you'd like on the specific portfolio itself. But let me begin with page 4, pages 4 and 5. Let's start on page 4. This is really a summary of, since this is a year-end review, if you will, of what happened in 2023. It seems like a long time ago now, but it certainly was a tale of two cities in terms of the market performance in 2022 versus the turnaround we saw in 2023. So there was a lot of good news, primarily focused on the direction that we saw inflation numbers coming in and the expectation that the Fed has essentially ceased its hiking strategy in order to quell inflation. And that the market was expecting that we would see cuts coming, frankly, in the first quarter of this year, 2024. That has not come to transpire, and I'll talk about that. But bottom line, it was a very solid year. If you look at the bottom line, the points I see, we continue to expect, and we've seen it so far in 2024, continued economic growth, mostly in the US, of about 1.2% growth in GDP. We do see geopolitical risks out there, which are weighing on the relative performance of natural resources, primarily oil stocks. China expectations are low and have moved lower for us, but also that speaks to an opportunity as investors. And while we've seen a lot of volatility near term in the fixed income markets, we do expect that in terms of the 10-year yield, where it will come in, it'll probably end up coming in the 4 to 4.5% range. And that's good news in terms of a portfolio like yours, which is heavily weighted, very conservative towards fixed income investments. If you go to page 5, just very quickly, you can see graphically what happened to in the fourth quarter. The items I've highlighted in yellow here are really some of the things that were holding the market down back in October, only to reverse course in the latter part of November and then in December, so that global equity markets in the fourth quarter overall came in at 11%. On page 6, again, you can see how drastically the market turned around probably most pronounced, first of all, from 2022 and 2023, your investment grade fixed income results. Again, in 2022, we saw, because of the precipitous rate hikes, investment grade bonds coming in at 13% negative. The first time we've seen that historically in decades. And then in 2023, reversed course. Over going into the other risk assets in the portfolio, we saw high yield markets come in at 13%, over 13%. And then over in your core equity portfolios, the US dominated, followed by developed markets outside the US, followed by emerging markets. A lot of these returns, I will note, you don't see it on this page here, accrued during the fourth quarter, namely November and December. And even real estate, which has mixed opinions as to really what's going to be going on in institutional real estate longer term. But at least the notion or the hope or expectation that rates would start to come down had a positive impact on globally traded real estate securities. Any questions on this page?
No.
Okay. So in terms of your overall portfolio, then, this is where you ended up in December. And again, to remind you, this chart shows you within that gold box on page 7, those are your investment policy statement targets that were adjusted back in 2022. And so you can see your risk assets are at 34%. So that comprises your core equities plus some other alternative real assets and high yield bonds. And then, of course, your risk control assets, which was your fixed income. Again, last year, it hurt you a lot because we saw the negative 13% coming in investment grade bonds. It was you and everybody else in this world who looked at their fixed income market portfolios and said, what the heck? This isn't what's supposed to happen. But it did. And now hopefully it's in the rearview mirror. In June, you'll see, actually, this is wrong. This should have been December. These are December numbers, I'm pretty certain. Came in, you can see the overall asset allocation. We were more heavily weighted towards risk assets in your portfolio versus your targets, but where it is coming from is primarily where we've kept your overweights to US equities, which, as you saw on the prior page, that helped, particularly during the fourth quarter. We kept emerging markets down, so we've underweighted. So that negative 2% red, that's versus your target. And we added it to high yield bonds, which had a great year. And on a risk adjusted basis, it's frankly our favorite asset class and has been for quite some time. And then if you go down into the risk control, we reduced your core fixed income and we added to cash. Cash having a yield of, at this time, like 5%. And given the amount of volatility we saw and continue to see in the fixed income markets, if you can get a 5% coupon on your money market, we prefer to leave it there. So there's some rebalancing we've been doing just in terms of keeping your cash on a higher level than target, but again, not giving up anything in terms of total return. Here is the detail for December. And again, you can see over on the left-hand side what the overall allocations were. And you ended, let me just make this a little bigger for myself too, so I can see it. You ended at 11.6. Let me just make this bigger, I apologize. So you ended at 11.9 million. Okay, and you right now are at, and this is pretty much right now where you are still at. Okay, the markets have been choppy. We ended February, and I just looked at your numbers now, you're pretty much right at 12 million. And you can see the overall asset allocation here. This was as of the end of the year. And today you're pretty much in the same position. You have added some money to the portfolio over in the past. I think I saw some money came in. So what we'll be doing right now from an overall perspective is rebalancing the month of February is closed. We're going to go in now and kind of evaluate every single holding in the portfolio, how that asset class and how that specific position performed during the months of January and February. And then we'll go ahead and be rebalancing the portfolio. I don't expect to see any major changes. We might be bringing your overweight into equities slightly down again, but that's, it will stay within your approved ranges. And so on this page, you can see that your total return for the year came in at 10%. Net of fees, Northern Trust advisory fee is 45 basis points. So it came in at 958. So there's a little bit of negative dispersion there, which I can explain. Your benchmark is right at 10%. The other thing I will note, if you go over to the since inception column, you'll see that your portfolio, I just was looking at the analysis that was done when you changed your asset allocation in terms of the expected long-term return and the amount of volatility in the portfolio. This portfolio is targeted to deliver approximately 4.5%, 4.8% on a gross basis, so compounded over the long term. Right now, you're sitting at just north of 5%. So the portfolio is absolutely delivering the kinds of returns you want to see over the long term. If we go over to the sort of nearer term, let's say the past 5 years, the total gross return was 5%, so under the target. 10 years, slightly under the target. But you can see, and what's impacting these numbers is 2022. 2022 has been a drag on your nearer term, on these, near term numbers. But overall, you're still, even, if you look at what happened in the month of December, you are up 4, 7.5. So these are the kinds of numbers that require you as investors to be patient and not to, change course or strategy drastically. So you get to those long-term numbers you're looking for in the portfolio. Okay, let's go to the next page, which is a risk, which is our base case. So again, what do we think is what we're expecting for the market? Now, this was in December. The story hasn't really changed that much in January, from now. But, again, we expect global growth to move below trend on a macro basis. But the U.S. economy clearly, even this week, still inflation numbers are coming in pretty much in consensus. They're coming down in the right direction. Consumer continues to support the economy. And the labor markets are very strong. So there's no reason to expect that we will have a recession. And in fact, we are much more now in the soft landing camp. With respect to the Fed's moves, we have always thought that any Fed rate hikes would take place the second half of this year. I have not heard our chief economist as yet say we're pushing that out further. Again, if the data keeps coming in the right direction, we would expect to see rate cuts sometime during probably end of the second quarter into the third quarter. And in terms of the risks, again, they continue geopolitical in terms of the Middle East. And then, of course, if the Fed, actually starts, cutting, rates faster or slower, if we're not positioned properly, in your case, you're not that much underweight risk. But if, you were underweight risk, then that could hurt the portfolio. And this is not really applicable in your situation. We have you slightly overweight risk in the areas which we think are safest, basically US equities and high yield bonds. I'm going to skip over page 10, but this is sort of just strategically where Northern sees things going. And you'll see on page 10, the plus in high yield is telling you basically where we want to be overweight. In this chart here, which is dated now, it says we're slightly underweight US equities and developed. We're actually still staying more underweight emerging markets and sort of equal weight US and developed. Let me go to another page here. So what I want to bring you to is slide, and which slide is this? And I think this will help tell the story. Slide 15. This really tells the story of what's going on in the market right now. And we'll get, the latest print for these numbers basically next week. But it's showing you, and this is what we've all been hearing about in the financial press. Where are the markets? How is the US market overpriced, underpriced? What's the impact on technology stocks? How are they influencing the indices more broadly? And what about the rest of the world? So as of the end of January, we saw US equities trading at a 25 times earnings multiple, where the long-term median is 17, 18. Now, that number is incredibly high. And what you should note is that if you strip out the large tech stocks that have been influencing the markets, that number is much lower. So this multiple is really being driven still by large tech growth companies. Opposite of that, you'll look down at emerging markets, and you'll see that emerging markets, actually in China in particular, are trading more at a discount to where they would be trading in the long term. So the challenge that all investors have right now, and that we have when we're trying to figure out how to position the portfolio, is this says there's an opportunity in emerging markets. We just don't know when. The other thing about emerging markets is the amount of volatility. So you have to balance expected return with the amount of volatility. Similarly, what's going on in the US, you don't want to give up, right, that growth that we've seen and continue to see in the US. But what you probably do want to do, and what we've been doing, is to make sure that within the portfolio, you're diversified across different market capitalizations. So you not only have large cap in the portfolio, you have some large cap growth, you also have some mid and small cap stocks. So again, in this kind of environment, we want to stay diversified, especially when we don't know, what's going to be happening over the next 3 to 6 months. And I will also, of course, say the election, while, there are lots of forecasters out there who will tell you if it's Democrats, if it's Republicans, if it's a mixed house, what have you, you'll have some volatility. But the Fed, as best we can tell, and our chief economist actually used to work for the Fed, will tell you that they're not looking at stock market. They're paying attention to the numbers. Okay. So I know we've got others to go, but their detail on the portfolio is in the back. We think it's very well positioned. We'll be rebalancing next week to make sure, in terms of the weights, US versus non-US, high yield bonds, making sure your core fixed income is earning that 3%, 4%, 5%. There's going to be some volatility in those numbers, by the way. But overall, we think the portfolio, we are not expecting to make any major strategic changes in the portfolio right now. And with that, I will be quiet and I will hand it back to you.
Thank you for the update, Ms. Bonney. Are there any questions or comments from the commissioners or staff, city attorney? I have two questions. With equities and risk assets at close to an all-time high, and we're 9.3% overweight, how soon do we want to get back to target?
Well, there's a couple of things. One, let's see. The answer is slowly. We're going to move back slowly. We'll be taking it. And I love in these kinds of markets to say, okay, as we're rebalancing, let's take some money off the table. The big question is, where do we put it, right? And so if we're going to put it in fixed income, for those of you who have been following the fixed income markets recently, again, rates popped back up because the concern was, okay, well, maybe the Fed's not going to start cutting rates as quickly as we would like. Therefore, we're seeing some slightly negative returns in core fixed income investment grade portfolios. I don't want to put any more into high yield. I think you're sufficiently exposed to high yield. So I actually see it as a trade-off between equities and equity exposures and just keeping them diversified, and moving into cash and to see for the very reason you're saying, if we have some kind of pullback, then we want to take that cash and redeploy it.
With intermediate corporates yielding 5%, which is close to our target or at our
Right.
target, why are we not utilizing that, trying to fix some of those intermediate term fixed income?
Well, I mean, they're there, but there has been volatility there. So let me just look at your holding. I'm looking at them right now here. Hold on. You're in other fixed income. So you've got global, your core is, let me just look at the products here again. So I look at the durations. So you have a blend of shorter duration. Your intermediate investment grade, you're right, came in right around, for the month, it came in at 4.5, but that was in December. These numbers have changed. We're looking at December numbers here now, and they have changed. So we've seen some price erosion even in intermediate core. But your point is well taken. Why not sort of, frankly, we think that a combination of corporate, intermediate, and high yield, the yields are very attractive. But like I said, if you're going to get 5% in cash or 5% in something where you're going to see some price appreciation or depreciation, I'm trying to spread it out between the two.
Yeah, but 5% in cash a year from now is going to be 4% in cash based on what you're saying
Correct.
about Fed rate cuts. So
Right.
wouldn't
Correct.
it make sense to lock in some of these in a 5 to 15-year range?
Your point is well taken, yes. And so you'll see, for example, you see your exposure to double line. You've got some corporates in there and you have some other things. They are locking in those yields. But I can, again, we always get nervous going a little too far out on the curve because we just don't know what's going to happen. And longer being out further on the curve right now hurt portfolios from a price perspective. And again, we're looking at December numbers here. January and February is a different story.
The other question I have is the exposure to commodities. They don't generate much income, if any, correct? The 3% we have in commodities?
Right.
Would it be wise to move that to dividend or interest paying securities?
Well, these flex shares do have some. These aren't pure commodities. These are dividend paying equities. I'd have to look at the fact sheet to see exactly what the dividend is. So you're not owning pure commodities. You're owning equity securities that participate in the commodity sector. So metals, energy, agriculture, and those companies do deliver yield. And so, what do I see? Percent of portfolio, I don't have the number right here. If I could look at another report, which isn't in here, to tell you what kind of yield you're getting off of those securities. It's just not in this particular report. Okay.
And lastly, with the inflation numbers coming in cooler, it seems, over the last 12 months, should we look at reducing our inflation protected securities? Looks like we have about 4% in inflation protected.
Yes, and so that it has been a recommendation that we'll be bringing. In fact, we've been bringing them down.
Okay.
So you'll point well taken, and actually keeping it shorter as well.
Okay.
I had a follow-up question. I was in the slower Fed transition. You think that, or Northern Trust is under the belief that there's going to be 3 rate cuts, so 75 basis points.
Yes.
What is the catalyst for that? What is?
Why is Northern been more conservative?
Yeah, which is what is?
Why are we? So we're more conservative in the street. The expectation that the last, this last mile, if you will, of this marathon of controlling inflation is going to take longer. And we've seen the stickiness, the biggest areas continue to be shelter. So housing markets, and also even food to a certain extent as well. So we just think the stickiness there, the Fed is not going to start cutting until they basically don't want to do what Volcker did back in the late 70s. They don't want to get caught. We don't want to get caught. The Fed doesn't want to get caught in a situation of having to raise rates again because they misread the inflation numbers. So they will be very stubborn about cutting.
Any other questions? Okay. Thank you for the update, Ms. Bonnie.
Thank you.
And note for the record, this is an informational item. There will be no commission action. So we will now take up items 2 and 3 together. Item 2, report from Siegel Marco Advisors regarding business and economic outlook. And item 3, report from Siegel Marco Advisors regarding the performance of the funds. I will turn it over to Mr. Nitt from Siegel Marco Advisors to present these items.
Thank you. First, let me say thank you again. We've been rehired as your investment consultant, assuming we can get the contract worked out.
Congrats.
So thank you. Look forward to continuing. So Jeremy, if you can go to 53. As usual, Allison gave a good coverage of what's been going on. I just wanted to hit a couple kind of detailed points. I think we all know in the US equity market what has happened style-wise, or the Magnificent Seven, as they're called. It just dominated returns last year. The big tech companies affiliated with artificial intelligence, one form or another. And you sort of can see that in the year-to-date returns, Russell 1000 growth, Russell 1000 value, greater than a 30% difference between those two benchmarks. Those big tech companies are all in the growth index. Since the end of the year, it started to crack a little bit. Tesla's weak, Apple's been a little bit weak, but NVIDIA is still shooting the lights out. So we still got some of that, maybe not quite as much as what we saw last year, but that really was the story last year. It was large cap growth. And you see that in the sectors down in the bottom right. Information technology and communication services, 55 to 60% for the year. Energy was negative. It was the only positive in 2022. So again, as Allison was saying, it was kind of a complete reversal of what we saw. And that's good because 2022 was horrible. But across the board, it was growth. And especially in the fourth quarter, and Allison alluded to this, that it was really right after Halloween, after some good inflation numbers came out below expectations, the market, stocks and bonds, just took off. And in the stock market, it was, everything went up a lot. And you get those kind of markets, some of the junkier stuff does well, especially in the smaller stocks, things that have no earnings. So I'll come back to that in a minute. But just those last 2 months of the year were really remarkable. Jeremy, if you can jump to 56. So here's the yield curves. And I just think at the upper right, it's interesting. The yellow and green lines, yellow was the end of June, green was the end of the year. Not that much difference. The brown was the end of September. So this was, the Fed did their last hike in July. Rates went up in the market, especially at the long end, really through October. And then everything changed and yields came way down in basically the last 2 months of the year. And that feeds through on the next page into performance. At the end of October, the US aggregate bond index was negative year to date, but it ended up positive 5.5% for the year. And again, that, the first quarter had been good, second and third quarters not so good, but those last 2 months really, really saved it. You see almost 7% in the quarter. So you got a decent return, much needed from bonds for the year. Okay, so page 60 then is, and again, we've got all the funds in here, but this is a good example. I've done a look at the allocations in all of the funds. This is where it was at the end of the year. And this one, I've got more updated data, which we'll look at in a minute through Monday, I think. So we'll kind of skip over this. And then on 62, we see performance. And it was a good quarter in both absolute, almost 10%, and relative terms. Your index fund is tracking the benchmark as it should. The underperformance in Boston Trust for the quarter and the year, this is completely in line. So they're a little more value oriented, a little more conservative. Don't own those small junky companies with no earnings. So their long-term record is still very good, but this is exactly the kind of year where they're going to struggle a little bit. They still kind of at about the middle of the pack in terms of small cap managers or small and mid cap managers. But very much, if you told me what had happened in the markets, I would have predicted this kind of relative performance for them. But still, a nice 13% absolute return for the year. The next page, then we have the international managers, and Dodge & Cox, the more value-oriented manager, Euro Pacific Growth, more growth-oriented. So not surprisingly, in the fourth quarter, Dodge & Cox lagged a little bit. But for the year, both of them outperformed, which is nice to see. And Euro Pacific had a couple of weak years prior to that, so it was good to see that turnaround. We have a lot of clients in this fund. We talk to them a lot, and I think things are going just fine. And the longer term results for both of these are very good. So this has been a really nice combination of funds to have there. And then fixed income at the bottom. So a good quarter, again, absolute and relative. Western, WAMCO, which had been lagging. This is classic Western. So you get a good quarter and they just shoot the lights out. So 9.5% almost for the quarter. So that brings them almost 1.5% ahead of the benchmark year to date. West also outperformed both in the quarter and the year, but not as much, just given the more aggressive nature of Western's portfolio. And we're going to talk some more about West in a minute. But again, you told me what was going to happen in the markets. I could have predicted, especially for Western, what the results would look like. Now, I can tell you so far this year, they're lagging because, as Allison was saying, things have turned around again. Rates have gone back up. So the more aggressive nature, and they have reined in their bets somewhat. They're not as long duration as they had been. They pulled in some of their exposure to high yield and credit and those sorts of things. But they've, it's still there. But that's fine. We just want to make sure we complement them appropriately. So that was really it for performance. Like I said, we'll talk about NetWest and again in a minute. Any questions on that?
Nope. Thank you for the update, Mr. Nip. Are there any other questions or comments? Hearing none. Note for the record, this is an informational item. There will be no commission action. That concludes the informational items on our agenda today. We have 4 action items before the commission today. The first 2 action items under consideration are continued from the last meeting. Action item number 1, impact feasibility of implementing potential divestment requirement for the Mount Hope Cemetery Fund. Action item number 2, impact feasibility of implementing potential divestment requirement for the Edwin A. Benjamin Memorial Fund, Jane Cameron La Jolla Library Fund, Philip L. Green Memorial Fund, Los Penasquitos Canyon Preserve Fund, Gladys Edna Peters Memorial Fund, and the FEE Sargent Memorial Fund. I will now pass it over to Jeremy Shortis, Office of Boards Liaison, to provide an update for these 2 items.
All right, awesome. Thanks, Chair Tam. So first, I did want to say thank you to the investment advisors, Allison and Jeff, for providing support on this item that came up as a result of the Rules Committee meeting and Councilmember LaCava's question. Based on the feedback provided, we were able to provide a response to Councilmember LaCava's office. And in the packet, pages 158 through 182, that is the response that was provided to the Rules Committee member, Councilmember LaCava's office. So you'll see there, and just one thing that I wanted to call attention to was our statement to his office, which was pretty much when taking into account the limited investment options that are available, the unproven performance and increased cost of these types of ESG funds, and the fiduciary responsibility imposed on the commission, it's our opinion that it would be prudent to not implement such a prohibition until we are able to obtain the long-term historical trends of available funds. So we'll flag this item and revisit the topic with the investment advisors in the coming years. So with that said, my recommendation on this item would be to table it indefinitely for a future meeting until we've heard, at least until we've heard from the council member's office. And that's it.
Okay. Are there any questions?
Yeah, I do. Did you get a response to this memo?
As of today, we have not.
Okay.
Yeah.
Thanks.
This was about a month ago. Memo was dated January 30th.
Correct.
Okay.
Yeah, Liz asked me to provide the update this afternoon, and in her message to me, she did not say, oh, by the way, we received a response. So I'm assuming that we have not received a response yet.
I'm sorry, one more follow-up.
Sure.
It's unusual, isn't it, for them to drill down on investments like that?
Yes. This, I don't know if you are aware, but this came up as a result of the presentation to the Rules Committee from the Funds Commission, and Councilmember LaCava, we had received notice that he was going to be asking a question about, the Treasurer's investment policy for the general city investments has a prohibition for certain ESG activity, like certain drilling activity, all of that. And he wondered, well, for the Funds Commission, could they potentially implement a similar prohibition in the investment policies? And so we took that back and did the research with Jeff and Allison and provided this response.
Okay, got it.
Jeff, what have you seen in your other accounts as far as ESG policies and how to respond to that?
Short answer is not a lot.
Mm-hmm.
Obviously it gets a lot of press, so questions come up. Of the clients I work with, which is more than 20, only one has actually done anything
Specifically.
And it's a kind of a form of religious institution whose board has directed the investment committee wherever possible do ESG, and they're particularly focused on fossil fuels. Please try to avoid these wherever possible. So their board even came out and said, we're okay if it costs something, either in fees or performance, that's okay, but that's our mission. So we're trying to align with that. That particular committee has done about half the portfolio that way. But that's the only one that has actually implemented anything.
Okay.
I would add, this is Allison, I would add that there's a lot of data coming out right now among institutional investors in terms of how much they're committing to their portfolios now, and the numbers are declining. In other words, it probably peaked maybe 2 years ago, and now because of a whole host of issues with regards to the quality of the data analytics, this concept called greenwashing, where there's been a proliferation of funds out there who claim to have sort of the qualifications or the grades, but when you look under the hood, they're actually not doing anything differently. And so there's been a pullback.
Okay. Are there any other questions or comments? Okay. Jeremy, thank you for providing us an update on these two items. Let's move on to the action. Is there a motion to table action items 1 and 2 and be revisited at a later time as determined by the commission?
Motion.
Perfect. We do have a motion to table the items.
Happy to second.
Perfect. And we have a second. So we have a motion by Commissioner John Peel and a second by City Attorney Mara Elliott. We'll now take roll call to count the vote. Commissioner John Peel.
Aye.
City Attorney Mara Elliott.
Aye.
And myself, Chair Tam, votes aye. That motion passes unanimously. The third action item under consideration is number 3, potential replacement of Met West Total Return Fund. I'll pass it over to Mr. Nip.
Thank you. So 183, Jeremy, is where we start this. So I worked with our manager research team to put together this report. I talked to them, described what was going on, what we might be looking for. So we've got 3 potential replacement candidates. But first, let me remind you about this Met West fund. So Met West was a separate firm that got acquired by TCW, Trust Company of the West. This is a fixed income team that's been together for a long time. There were 4 senior portfolio managers on this team. One of them retired a couple of years ago. Late last year, they announced a second one that was going to retire at year end, so just passed. He has retired. The third one is going to retire at the end of this year. So only one of the 4 original portfolio managers is going to be there after this year. Now, they've got lots of other people who work there who've been there a long time, but not quite in the high profile roles that these others have had. We've also seen, although they did better in the fourth quarter, some relatively weak performance out of them. So we thought it made sense to look at, should we replace them? I talked about Western before, pretty aggressive, volatile manager, very good over the long term, but is part of what we want to think about is what's going to be the best complement to them. So that's some of the work that we're going to look at here. So Jeremy, the next page just sort of summarizes. There's a lot of detail in this report. I'm not going to go through all of it. We'll focus on kind of the first couple of sections. The next page just kind of outlines what are we looking for. Again, complement Western. This is a broad market core or core plus portfolio. That core plus term means it can buy things beyond investment grade, typically high yield or maybe some foreign securities. Very, very common. That's what Western does in their portfolio. We need a mutual fund vehicle. I said we'd like it to be no more expensive than what we're paying now. So 45 basis points or less. And all of these are actually cheaper, which is good. So working with the team, we identified the 3 candidates listed here. Allspring, this used to be the investment management arm of Wells Fargo, which was spun off into a separate entity. Baird, which is a longstanding firm based in Milwaukee, and PGIM, that's Prudential. So this team is based in their headquarters in Newark. The Allspring team is actually in Walnut Creek, about 5 miles from my house, that runs this portfolio. Okay, next page. Just real quickly, this is our process for researching managers. There's a lot of elements to it. We're looking at the firm, we're looking at the team, what's their strategy, how do they do it, what kind of back office operations do they have, what's their performance been, is it a proof statement of their approach, and terms, which in this case basically means fees. So for all the managers that we research, we look at these factors, and there's a lot of kind of sub-factors that go into it. And our team rates managers. Our recommended rating is the highest. Sometimes if it's early on, and we'll see an example of that in a minute, there may be no rating applied yet. But this is what all of this work is based on. All right, so let's go ahead. There's some more details. Another page. Again, here's the 3 firms. I kind of talked about who they are and where they are. These are all well-established, long-standing firms. Next page is some detail on each of the 3. So this is the Allspring Fund. The next page is Baird, and then after that is Prudential. You got it at leisure if you want to, but we'll go on to some summaries. So here's some information on portfolio characteristics. And I think this is where you're going to see some differences between these. The aggregate index is over there to the right. The light blue means very heavily AAA. So a lot of government securities in that index. Most managers, including these, don't tend to have as much of those. They tend to go for some of the higher yielding segments of the market. Now, Allspring this is more of a core. They can do a little bit of high yield, but not much. So you're going to see that kind of not rated category. Well, that's AA. So that's where they've got a lot. Prudential, on the other hand, don't love the colors here, but that's a darker green. They're going to do more in high yield than the others. And we'll see that again. Other thing to look at is duration. Right now, they're all pretty close to the index. So that's the fourth line there. It says average effective duration. Baird is always going to stay very close. The others can vary. Allspring can vary plus or minus 10%. So if the duration of the index is, say, 6 years, that means they could be anywhere from 5.4 to 6.6. Prudential also can take a little more variation on their duration, whereas Baird will stick very, very close to the index. You also see the yield. Now, this is a point in time at the end of the year, but because Prudential tends to have more high yield, they tend to have a higher yield in the overall portfolio. Some more detail on holdings, the next page. So here's a pretty good breakdown. You can see they're all underweight treasuries, especially Prudential. Always going to have a pretty good holding in investment grade corporates, but only Prudential's actually, well, Baird slightly more than the index. But then you come down, you see some big differences. So Allspring's doing a lot in mortgages. And again, this is a point in time, and these can change. But you see high yield, almost 10% in Prudential, almost nothing in Allspring. Baird has a little bit of high yield, but they also have a pretty good bit of non-dollar in their portfolio. That's where they're seeing opportunities. So there is some difference in the makeup of these portfolios. Fees are on the next page. So bottom line, I said these are all cheaper than 45 we're paying now. Baird is the cheapest at 30. These are all mutual funds. 38 for Allspring and 40 for Prudential. Now, you'll note this is labeled at the top, PGIM ESG. So they have a standard core plus strategy, which a lot of the information in here, especially performance, is based on. A couple of years ago, they launched a new ESG version of that strategy. So the ESG fund is 40 basis points. The standard version is 39 basis points, so almost the same. If you look at the product asset line up there, so Prudential has 89 billion in the core plus strategy, but only 22 million in the ESG strategy. This reflects how new it is, and this is part of the issue with these strategies. Is there's just not a lot, a long-term record of these. But we thought it made sense to kind of throw that in the mix here, given the issues that had come up at that rules committee meeting. So basically, two versions of Prudential, the standard and the ESG version. More detail on fees on the next page. The one thing to note there is if you look at those percentiles at the top, so the far right column, between 30 and 40 basis points. So 40 basis points, that's the lowest quartile of fees for bond funds of this type. So these are all very attractively priced for what they're doing. And that's important, I think, especially in bonds, because you don't want to be paying away a lot of fees, because it's not like you're going to be generating double-digit returns out of these. So that's kind of the backdrop of what these are. The next few pages show performance numbers. Small, but a little hard to see. But basically, long-term results are all good relative to the benchmark. We included both PGIM strategies in there, but again, the ESG version only has, it's really a couple years, but we don't have a 2-year column, so you see a 1-year return for it, but nothing longer. But the longer record is the standard core plus strategy that they have. The next several pages are more detail. So there's calendar year performance. Page 198, Jeremy. So yeah, so this I think is a very important page. this is the correlation of active returns relative to the benchmark for these managers versus Western. So basically, when Western is outperforming or underperforming, what are these managers doing? And if you just look down the Western asset column. So the first set of numbers, that's 2 years. So that was so we could pick up the ESG product from PGIM. The middle set of numbers is 3 years, and the bottom set of numbers is 5 years. So if you just look down the Western asset column, you can see these excess return correlations for these managers relative to Western. And go really to the 3 and 5 years, because longer term is better. You see 0.8 correlation between MetWest and Western, which means they're moving pretty much in the same direction. They're either both outperforming or both underperforming at the same time. These other managers have correlations more like 0.6 or 0.7. So you're getting a little more diversification of their performance relative to Western. Again, that was one of the things we're looking for here, is to try to better complement Western. So this again, I think is a particularly important page, just because you can see that all of these other ones do a better job, I would say, of complementing Western than the existing MetWest strategy does. Then there's lots more information on volatility. I would go, Jeremy, to 206 because these are pictures. So here's Allspring. So these are rolling 5-year periods, and that line is the benchmark. So over 5-year periods, are they above or below the benchmark? So you can see, there's a few that they're under. This is 207 rolling 5-year periods. And 87% of the time over, pick any 5-year period, they're outperforming. Next page is Baird. 96% of the time they're outperforming over a 5-year period. And then PGIM, this is the kind of standard core plus, 99% of the time they're outperforming over 5 years. So again, I think thinking long term, those are kind of helpful to look at. All of those are very good results over a 5-year period. There's lots more text in here, but I think that's really the basics. Sorry,
I have a quick question. The PG, the Core Plus.
Yes.
That's not the ESG fund.
Right. This is the standard product.
Standard. Okay.
Right.
So this, because that's only 2 years.
Yeah.
Okay.
Yeah. So we couldn't do this graph for that one because it's only been around for 2 years. So the last thing I wanted to mention is I actually reached back out to our research team today because I knew they had been trying to set up a meeting with MetWest, and they sure enough on Monday they met with him. And so our research guy said, yeah, he had the opportunity to meet some of these, not new, but people kind of stepping up to take these roles. They're experienced. Feels like that'll be fine, but it's change. That the 4 people who kind of built the track record, 3 of them are about to either gone or about to be gone. He said this is definitely not something we're going to say, oh, if you've got to sell it, you've got to get rid of it. But he's debating whether this is going to be a recommended strategy or just something kind of more neutral. And he said, I want to think about it. He was literally just there. But I just wanted to pass along that piece of news too. So I think, and again, especially based on what's going to complement Western, I think making a change makes sense. And all of these are good. I personally know all of these managers. I've had experience with all of them. I can tell you that when we first started with this, the first one I thought of was Baird. Just knowing them, I know their fees are low. I know the team is very experienced. I will tell you that they have co-CIOs. The woman, Mary Ellen Stanek, who's one of those co-CIOs, she's going to retire at some point. She's probably got a year or two left. Nothing's been announced. But again, everybody else has been there a long time. But they were the first one I thought of for this kind of role, primarily because of how tight they are on duration to the benchmark. Whereas we know Western will move that around. But I'd be perfectly happy with any of them. I think Allspring is probably the most plain vanilla portfolio. Baird kind of in the middle, and then Prudential is more high yield, so a little more non-core stuff in their portfolio. Questions, thoughts?
Yeah, just curious as to the thought process between choosing Core Plus versus Core for the second fund.
Yeah, and we talked about that. So this Allspring fund is basically a core fund with a smattering of high yield. I think the idea is because it's the nature of these portfolios, you don't have and shouldn't have a dedicated high yield fund. So we want to give the managers kind of the broadest opportunity set possible. So rather than saying, oh yeah, absolutely can't have any high yield in it. No, let's let them do that if they want to. So I think some version of Core Plus makes sense. But again, we wanted to kind of give you a spectrum of those here. So most conservative with Allspring to most aggressive, I'll use that term, with Prudential, but Western is out there even further.
So the PGIM fund seems to have a majority of their bonds in unrated bonds. What would you classify? Where would you put them on the credit scale?
Yeah, that's those colors are I don't like. So I think on 193, Jeremy, if you go back to that page, I think this is more helpful. So basically, they got 30% investment grade corporate. Another 27% or so in mortgages, and 20% in asset backs. So that's a big difference between them and some others, especially the asset backs. Again, I think they will typically have more high yield than the others, but this is 10%, so it's not extreme. The colors on that previous chart, there's something weird about that. So I'd focus more on this page.
Okay.
But one thing that stands out on this page is the Allspring has about 28% in mortgage-backed securities. Is that to replicate the index? Is that the thought process there? You said they're more plain vanilla. Is that?
Yeah, they are. So I think a lot of that is like all of them, they're underweight treasuries. So that's kind of the next step away from treasuries. Okay, these are still high quality securities. They're going to yield a little bit more than the treasuries are. So I'm gonna do that. And this is again this sort of conservative, plain vanilla approach that they have. Allspring is as opposed to like a Western, that's sort of part of what they're doing is making kind of top-down macro calls and positioning duration. Allspring is very much bottom-up. So they're picking individual bonds, individual securities. So it's a very kind of on the ground. And in mortgages, then they're looking at, okay, all these mortgage securities, which ones do we think are priced most appropriate or inappropriately that offer the best opportunity for us. So it's kind of more security selection oriented in what they do. And they will even talk about, you don't hear many bond managers talk about information ratio. So they're looking at their tracking error relative to the index. And they want to get as much return as they can for the tracking error that they're taking. That's the return divided by the tracking error is the information ratio. Most managers don't talk about that. but they do. That is a particular focus of theirs. And it's this idea of delivering. They're never going to be the top performer, but they're trying to deliver kind of consistent small outperformance is what they're doing.
So it looks like Baird has quite a bit more international exposure than the other bond funds.
Yeah.
Are we going to reduce our international exposure in other funds to compensate for that additional international component?
I don't think you need to. First of all, what you've got is international equities, not bonds.
Mhm.
So what you are picking up is some currency exposure. This is not going to be permanent. I think this is partly opportunistic on their part. But this would be sort of half of your bond portfolio, then it's call it 15% of that half, and so the impact on the overall portfolio not that great.
Okay. Mr. Knipp, thank you for bringing this item to the commission. Are there any other questions? Okay, this item does require a vote of the commission to decide on whether to replace the MetWest manager. Did we get a recommendation out of the three?
I will recommend making a change.
Yes.
If you're going to push me on which of these three, I would pick Baird. But again, I would be very happy with any of them. I'd be very comfortable. It's really, what appeals to you the most.
Baird has the lowest fees.
It does. Yes.
Also has low correlation.
Yeah.
And also 96% outperformance of the index.
Yes.
But it does have the international. Okay. So this item does require a vote of the commission to decide on whether to replace the MetWest manager. Is there a motion to replace the MetWest manager with Baird?
I'll make a motion to replace the MetWest manager with Baird.
I will second. Is there any further discussion on the motion? Okay, we have a motion by Commissioner John Peel and a second by Chair Tam. We will now take roll call to count the vote. Commissioner John Peel.
Aye.
City Attorney Mary Elliott.
Aye.
And myself, Chair Tam. Aye. This motion passes unanimously. All right, the fourth action item under consideration is a rebalancing recommendation from Siegel Marco Advisors. I will pass it back to you, Mr. Knipp.
Okay, thank you. Jeremy, this is page 245. 245 on the one I've got.
Yes.
Oh.
So yeah, no, I completely forgot to update the item on my desktop. Let me, apologies.
While he's doing that, let me give you the little story.
Sure.
So there are 6 funds that we oversee. 3 of those have quarterly distributions. So we're basically able to rebalance those pretty well because every quarter we look when we need to take a distribution, what's overweighted, that's where we'll go to take the money. The other 3 tend to just kind of run along. Obviously, in your investment policy statement, you've got ranges for the total asset class level. And because there's 2 managers in each asset class, domestic equity, international equity, and fixed income, there are what I call implied ranges around those. The international and fixed income managers are basically each supposed to have half of the money in that asset class. In domestic equity, there's more in large cap than there is in small and mid cap, which makes sense. So I put together a spreadsheet, which I used before a couple of years ago, the last time we did this, I did this on Monday, or on Tuesday actually, so through Monday, to see where the allocations were and see if it made sense to do any rebalancing.
Are you good if I just pull up the
Yeah,
Excel?
yeah, that's fine.
Okay, let me do
Yeah.
that. Because otherwise opening up the 200 something
Yeah.
page from a shared drive is going to take forever.
Okay. So the three highlighted in yellow, the Benjamin, Cameron, and Green funds, those are the three that do not have quarterly distributions. So on the left, you can see the far left, 40% target for US equity, 25% for international, 35% for fixed income. And then again, in international and fixed income, the idea is the managers each have half of that allocation. In domestic equity, 3/4 of it is large cap, 1/4 of it is small and mid cap. So that's the 30-10 that you see there. Over then on the other side, on the far right, you see those implied policy ranges. The ones in bold, those are the actual policy ranges for the total asset class. But then we've got implied ranges for each individual manager. A good rule of thumb, and we used this a couple of years ago when we did this, is if you get more than halfway from your policy to the upper or lower limit of your range, it's good to think about doing some rebalancing. So in those three highlighted funds, if you focus on the large cap, so the VFIAX, that's the Vanguard Index Fund, those are all somewhere close to 34.5%, up from a 30% target weight. So that, call it 34.5%. That's more than halfway to that upper 37.5 limit that you see over there on the right. So okay, that's the target for potential rebalancing. We should maybe take some money out of those and redeploy it. And where it needs to go is into fixed income. International equity is pretty close. So nothing really needs to be done there. But fixed income is underweight. And you see those three funds, Benjamin, Cameron, and Green, are all under 30% weights in the total fixed income line, that blue line at the bottom. So again, they're more than halfway to their lower limit of 25, given that their policy target is 35. So what I'm recommending here is for Benjamin, Cameron, and Green, that we take 3.5% out of the Vanguard 500 Index Fund, and we redeploy that into the two bond managers. And because Western has less than what's now MetWest, but will be somebody else, Baird, I'm recommending that of that 3.5%, 2% goes to Western, 1.5% goes to the other manager, which will now be Baird. And that's I put a little asterisk on, on there to say MWTIX, that's MetWest or replacement fund. So that'll bring those two bond funds more in line with each other. And it'll bring the policy, the actual allocation to fixed income more in line with the policy. It won't get it all the way there, but it'll get us part of the way there. And I think that's also a good way to do it. You don't necessarily have to do all at once, but kind of take a step in the right direction, get it tighter to where it should be. We can always revisit this. If we see stocks continue to run up and bonds continue to run down, we might have to revisit. But I think for now that kind of rebalancing would make sense. So that's what I'm recommending.
Okay. Are there any questions or comments from the commissioners? Does rebalancing always require action by the commission? Because we're just bringing it back to target, right?
I think because you're not outside of the range, in which case you would be required to rebalance.
Yeah.
And we've only done this once, which was a couple of years ago. And I know at that time it was an action item, and we did it that way. So I think the fact that it's not a required rebalance.
I see.
Yes.
Okay. Okay, this item does require a vote of the commission to decide on whether or not to rebalance. Is there a motion to accept the rebalancing recommendation?
So moved.
I have a motion to accept the rebalancing
I'll second it.
recommendation, and we have a second. So motion by City Attorney Mayor Elliott, second by Commissioner John Peel. We will now take roll to count the votes. Commissioner John Peel.
Aye.
City Attorney Mayor Elliott.
Aye.
And myself, Chair Tam, votes aye. That motion passes unanimously. That concludes the action.
I'm sorry. Oh,
sorry.
I'll let you finish that.
That concludes the action items today.
I
back
wanted
to
to
you.
just step back to the prior action
Yes.
item because oops, I just lost the page. We voted to replace, but didn't we have to say with whom?
We voted to replace with Baird.
Oh, okay, I didn't
Mhm.
get that part of the motion.
Yes.
So, all right.
That should have been recorded, hopefully.
Yeah.
Okay,
Yeah.
good.
Thank you. I just missed that. I apologize.
We didn't vote for Baird.
Okay.
And if I may, along those lines, so the way this should work, given that we're making that change, obviously you don't want to rebalance, put money in the Met West fund and then take it out.
Right.
So the first thing we need to do is replace
Replace the
Met
fund.
West with Baird.
Yeah,
Once that's done,
Then
we'll do
rebalance.
the rebalancing.
Yeah. yeah, that's a good explanation. Thank you. Any other questions or comments? I think we're good. We will now move on to the next item on the agenda, non-agenda public comment. At each meeting, we invite public comment for up to 3 minutes about issues within the commission's jurisdiction, but not on the agenda. This afternoon, we have 0 speaker slips turned in for non-agenda public comment. So we will move on to the next item, scheduling of next meeting. So let's look at availability, May 2024.
Is there any benefit in waiting and getting it closer to the quarter? Can we wait? I mean, we're like 2
Yeah.
months out of date with our data. I don't know.
Yeah, I think the only issue is for the investment advisors to provide the reports to us in time. And I think that's the reason why it's usually a month and a half after the
Okay,
quarter
so that
close.
works. Okay.
Yeah, we can do ours because ours is just mutual funds.
Yeah.
We can do that within about a month or so.
Mm,
I'm not sure about
We
Allison.
could go earlier in May.
No, yeah, I could do it earlier. Sort of. End of-
I was just thinking out loud.
All right. Today's a Thursday. How is Thursday, May 23rd? I hear no objections.
I'm sorry. Yeah.
Hold on, I'm scrolling across my calendar. Okay, May 23rd, Thursday. That's good for me, Allison.
I would have a conflict at 3 o'clock. I have a meeting in Poway, so
Mm,
it depends on how long we go unless we can start a little bit early.
We start at 1 p.m. Is 1 p.m. okay with everyone?
Works for me.
Perfect. Just take an early lunch. So May 23rd, 1 p.m. in this location, Jeremy?
I can check to see if it's available. If
Perfect.
not, we do have a renovated conference room on the 4th floor.
Oh, so it'd be same building at the very least, the library?
No.
In the Civic.
Yeah.
Okay, got it.
We'll look for a location and definitely
Perfect.
have an in-person location.
I definitely like the parking lot a little better. Okay. I think this brings us to the end of our meeting. The next Funds Commission meeting is scheduled for May 23rd. That's a Thursday at 1 p.m. Meeting adjourned. Thanks, everyone.
Thank you.
And the time is 2:40.
2:46 p.m. Sorry. There we go.